So we have a little question on the screen since I think it was International Water Day or something yesterday, and I think maybe it's even Water Week. So what is your favorite beverage made from water? And mine is really simple, and it's one that's good for New Mexico. I love iced tea. I've always got my little glass of iced tea, or my big glass as the case may be, sitting beside me. So my favorite thing is iced tea. So we got another iced tea, woohoo, and coffee from Luke. So go ahead and just try out the chat feature, because we will try to use that, and just type in your favorite drink, whatever it is with water. Ice water, that's a good one. So again, just, it's a chance for you guys to just sort of try out the chat feature and see what that's like. And I'll remind you again later, but water mixed with lemon and apple cider, wow. And so we're just trying to, kind of get you familiar with some of the features. And again, if you have a really long question, it's too hard to type in, we can always use the mute and unmute feature if you have a microphone on your computer. And I do want to let everybody know that we're going to record the session today. And that's so if there are other people from your organization that weren't able to make it, we can make this presentation available to them. They're welcome to listen in. If there's anything you want to review, you can do that as well. And it will also be available for people who weren't able to join us today. Although the CEU only apply if you sign up today. The CEUs don't count if you watch the recording. Oh, so we got water, lemon and ice, lemonade. We got a lot of good drinks. Okay, so I think we have a good group on right now. So we're going to go ahead and get started with our content today. So I wanted to let everybody know this is brought to us today by the United States EPA. It is, and the Environmental Finance Center Network, of which we're a part. This is a grant from them to help small systems across the United States. Originally, when we did this project, it was in person. We did trainings all across the country, but we had to go virtual in this pandemic environment. We couldn't do it in person anymore. We're hoping, maybe in a few more months, we'll be able to do that again. But for now, all the trainings that we're doing are virtual. There is a project website that has all things small systems project. You can either Google EFC Network, or you can type in efcnetwork.org and you'll bring up everything from the website. Workshops and webinars appear here. Right now, they're only webinars. There are no workshops, but over time, we will have we'll have other things available, other workshops available, and you can go to any workshop that you want. There's also resources tab, there's a blog tab, and then there's an assistance tab. If you click the assistance tab, you can fill out a request for assistance from us, and it is of no cost to you. It's paid for by EPA. So if anybody wants assistance, the only requirement is that you be a small water system, which is defined as 10,000 population or fewer. So almost everybody in New Mexico qualifies. There's only a couple of systems across the state that are too big to qualify. We are the Southwest Environmental Finance Center. And so we are, again, part of that Environmental Finance Center network. And our mission is to promote self-reliance through innovative training and assistance focused on actionable results. We are part of the University of New Mexico School of Engineering. And we've been in existence since 1992. And I took over as director since 1996. So I've been in this organization for quite some time. We do a lot of different things related to water systems. We do capacity development, which is technical, managerial, financial capabilities. We do asset management. We do water loss. We do rate setting. So there's lots of different activities within the Southwest Environmental Finance Center. And now the three of us who are going to be your trainers for today will introduce ourselves. And my name is Heather Himmelberger. I'm the director of the Southwest EFC. I am an engineer by training, but I'm in operations management and finance by choice. I really like working one-on-one with water utilities and doing training. I like getting out there and seeing how I can help solve problems, how I can build internal capabilities so that you're good to go on your own after that. I've traveled extensively across the United States. I've been to every state at least a couple of times each, been to all the territories, and I've worked with water and wastewater in just about all those places. But New Mexico is home. It's been home for about 27 years now, I think it's been. I love New Mexico, and I'm really glad to be here with all of you. So with that, I'm going to turn it to Sandy, if you want to introduce yourselves.
My name is Sandy Blanton. I'm an accountant by training. I'm a gardener by passion. My natural element is playing in the dirt, but nobody pays me for that, so I do other things as well. I've been with the EFC since 2003. I've done a lot of things besides accounting, finance. I've done rate setting. I do a lot of writing, grant proposal writing, editing, that kind of thing. I'm a generalist by nature, so I kind of do whatever somebody asks me to do if I can do it.
Kind of that other duties as assigned sort of thing.
Other duties as assigned, this is one of those.
And now Luke.
Hi, my name's Luke Andrews. I'm a Michigan transplant. I've been in New Mexico about 6.5 years now. I'm a geographer by training, and in addition to GIS and mapping work, I also do affordability and rate setting work at the EFC as part of that other duties as assigned that Sandy was discussing there.
Great. And now we have a chance to have you guys introduce yourselves. If you don't mind, again, use the chat feature for this. We have kind of too many people to unmute everybody and go around that way. But if you could just type your name and organization and your role in the chat feature, if you're able to do that, and just so we know who's here. And I did want to thank the folks who have their cameras on. It's nice to see faces. Sometimes we don't get to see who's out there. So it's, thank you to those who do have your cameras on. We appreciate that. It makes it feel a little more like we're in the room together as a group instead of what is normally like of just teaching to a black screen. So I appreciate that. So, and thank you for the folks who have started putting in your names. I really appreciate that. And for the rest of you, you can keep on typing as I just go on to remind a couple of things. You can type questions into the chat feature as we go. So any question that you have, go ahead and type it in. And we'll either answer the question right then, or there might be some cases where you have to hold the question until later because it might turn out that we're going to get to it, or maybe it's too long and we have to wait a little bit. So in one way or another, we will answer your questions, but go ahead and type them in as we go and we'll answer them in the most appropriate time slot. I did want to let you know that we're kind of basing this training off a resource that we have available for you. And this is, again, a completely free resource. And it's called the Water Utility Financial Analysis Tool. And it has sections that cover many of the items we're going to talk about today. So it's something that you could use for tracking assets and liabilities, expenses, revenues, financial indicators, which I'm going to talk about in a little bit. So it's kind of a tool that you can use for many of the things that we're going to talk about today. The one thing that's not included is the rate setting that Luke is going to talk about, but there are other tools available to help you do that. You can access this tool through direct links on the screen, and we can chat those links in as well. And you can also access the tool through searching the EFC website. So you can look for, if you type in SW EFC or Southwest EFC, or the first thing that comes up on Google, or you can use the link here and get to the website that way. Once you're at the website, you would click on resources. You would check or click on all specialty areas and a pop-up window will show up. And it will normally be under here, but I just pulled it up so we could see it. And rates and financial sustainability would be what you would want to pick. And then there's two tools. The one that you would want is the Water Utility Financial Analysis tool. And you would choose Read More. And then that opens this up. And then we would select Go to Tool. And then we would be at the tool. And at that point, you can enter data. You actually have a couple of choices. You can enter your own data, and we do not save any of your data. It doesn't go anywhere near UNM's computers or anything. It's all saved locally on your own, or it's all locally in your own browser. So it is not saved by us, but there's also sample data that you can see up in this block here. So if you ever want to see how the tool works, you can click on the sample data and you can just see how the tool populates and what's in the tool. But we're going to show a little bit more about the tool later on. But right now we're going to turn it over to, I'm going to turn it over to Sandy. I'm going to stop sharing my screen and let Sandy share her screen with the slides that she has to talk about the understanding budgets, revenues, expenses, assets and liabilities, and financial reports. So she's going to do all things financial for us.
Okay, and if I manage to do this without mucking it up, it'll be a miracle.
Yeah, we're all getting used to new technology these days.
Hopefully you guys can see my screen now.
Yes, looks like it's sharing properly, Sandy.
So good morning. I appreciate you joining us here today. As I said earlier, my name is Sandy Blanton. I am a retired CPA. Been working for the Southwest Environmental Finance Center for a while. I'm going to talk about New Mexico financial and accounting principles. For some of you, this might seem a little basic, but hey, why won't my screen advance? Help. You guys, I need help because I can't make it go forward.
Do you need to try the arrows on the bottom, in the bottom right?
I'm trying the arrows on my keyboard, but okay, there we go. I'm going to cover 4 broad financial areas this morning quickly in a sort of basic way. And I hope it'll be, for some of you, it might be a little too basic, but I hope everybody gets something out of it. We're going to start from the bottom, work our way up. We'll start with the chart of accounts and the budgets, how they fit together. We'll move on to what I consider the meat of your business, revenue and expenses, and how they're related. This is kind of your day-to-day life. Take in money, pay bills, right? After that, we move to what I call the other side of the equation, which is assets and liability, basically what you own and what you owe. Finally, we'll talk about the 2 main financial statements that you need to be familiar with. First topic is chart of accounts and budgets, and I hope to help you understand these 2 topics and how they're related and why they're important. So what is a chart of accounts? It's like a filing system, the base of your financial system, and it has an account for everything financial that you do and that you have to keep track of, like take in money, pay bills, buy equipment, take out a loan, all of that's in there. Organized into 4 basic categories: revenues, expenses, assets, and liabilities. All of the accounts in each category have a similar kind of number. For example, your revenue counts all might start with 4,000 and expenses with 5,000, so on. If your system is really small, it might seem easier just to remember all this stuff. But you really do need a formal chart of accounts for several reasons. One is that the state of New Mexico is now requiring budget reporting, and you must use their chart of accounts. Another is it really makes it easier for you to do your budget. And the final reason, very important, even though you may have all this in your head, you may not always be there. You owe it to your successors to set up a chart of accounts and formal budgeting system so that they can understand what's going on. So you can have as many or as few accounts as you need. You could have one account for all your cash. You could have one account for cash in the bank at First National Bank, one account for Wells Fargo. You could, you know, it's a formal system. It's a rigid system, but should be flexible enough for you to put in whatever you need. Where do we get one? If you have an accounting and billing software, you already most likely have one. If you don't, you can download the chart of accounts from the local government division of the New Mexico Department of Finance and Administration. If you already have a chart of accounts that's not theirs, you need to match yours to theirs. So on the screen, you see what looks like a link. Obviously, you can't link it, but when I'm finished here, I will put that in the chat so you can have it. So if your water system is part of a larger entity like a city, a town, or a pueblo, you're likely an enterprise fund. That means your chart of accounts is contained within the larger entity's chart of accounts. So it's kind of like you're nested in there. It has its own, you have your own little section within the bigger chart of accounts. If you're not an enterprise fund, then you are some type of standalone water system. You could be a mutual domestic water consumer association. You could also still be a tribal or city-owned water system, but operated as a standalone. In that case, you would have your own separate chart of accounts. It still must match the one at the LGBMS site. I have a hard time with that. It doesn't roll off the tongue. So we're going to move on to budgets. What is a budget really? Is it a prediction or is it a guide? What is it? Really both. The key thing here is the budget categories need to match the chart of accounts categories. Otherwise, you have no hope of comparing things. So your best aid in doing the budget is to look carefully at how things went in the last few years. Is your revenue changing? What direction? Going up, going down? What's driving the changes? It could be population changes, rate increases, water conservation. Water conservation can decrease your revenue. Rate increase seemingly would increase your revenue, but if it causes users to conserve water, it could actually decrease your revenue. Then look at your expenses. Have they gone up or down in the last few years? My guess is up, right? Because expenses always go up. And you should always count on some amount of inflation. What else do you know about your expenses for the next year? Are you planning to hire new operators or other staff? Are there new regulations that you will have to adhere to, do more sampling, more testing, whatever? Are you aware of repairs that are coming up that you will need? What other plans might you have for the next year that would impact revenues and expenses? So who needs a budget? All financial entities need to have a budget. Some people might argue that even every individual household, which after all is a kind of financial entity, needs a budget. Probably most of us don't have one very formally, but my guess is that we have one sort of informally in our heads because we know how much we make, we know what has to be paid. But the state of New Mexico requires all systems in New Mexico with operating revenues greater than $50,000 to submit an annual budget to the New Mexico Department of Finance and Government through the local government budget management system. You can access these requirements at this website, same website. I will put it in the chat. By the way, you may not meet that $50,000 limit right now, but it can sneak up on you. If, for instance, you have a rate increase or an increase in customers, get a lot of new customers, you can jump up to that number pretty quickly. What are we going to do with it once we have it? Well, we're going to send it to the state, clearly. But it's mainly for your own use in managing your utility throughout the year. One of the best uses of your budget is to compare it with your actual expenses as you go through the year. I'm going to move on to revenues and expenses, our third big category, second big category. I don't know where I am. Revenues and expenses are shown on the income statement, also known as a profit and loss statement or a P&L. We're going to talk about these statements a little bit later, but bear with me right now. The revenue is the money you take in the course of your business. There are two types of revenue. It's really important to understand the difference between them. Operating money is the money you take in for the main water services you provide. Basically, the sale of water and other regular charges for your service. This is revenue that comes from your rates. Non-operating revenue could encompass any money that you get in that is not specifically tied to the main water service you provide. You can see on the screen, we've listed some types of operating revenues, some types of non-operating revenue. There's a lot more of them there could be. And some people might argue that some of the ones listed as non-operating might really be operating revenue. That's perfectly reasonable. Water managers can make these kinds of decisions. But the main criteria is it a part of the service, the regular service for everyone? And is it regular? Operating revenue and non-operating revenue are shown in different sections of the income statement. So operating revenues, I'm sorry, we're moving on to expenses. Operating expenses are what you use to run your business every day. Most of your regular day-to-day business expenses that you pay for are operating expenses. There's lots of examples listed here. Obviously, there's a lot more that you have, you know that probably. I just want to point out when we say vehicle cost, we are not talking about buying a vehicle. We're talking about the cost to operate the vehicle. That's an operating expense. Non-operating expense are occasional things that are not related to producing and selling the water. It could be things like planning services. Depreciation usually comes in here, taxes, interests on loans. When we do the income statement, we're going to match operating expenses with operating revenue, non-operating expenses with non-operating revenue. So now we're going to move to a little highlight of assets and liabilities.
And Sandy, I just wanted to let everybody know, I did put in the chat the link that you had shared.
Okay, thank you, Heather. I appreciate it.
So I took care of that. So the LGBMS, whatever that acronym is, that is in the chat now. If anybody wants to, it is in the chat now.
Thank you. I appreciate that. So assets and liabilities may be one of the least understood parts of the financial picture. Or maybe not. I don't know. Assets and liabilities are shown on the balance sheet, which is the other main financial statement that you may end up dealing with. They are never shown on the income statement. And we're going to get to this. Asset is anything you own that has value. Assets come in two types: current assets, which are those that can be converted to cash in a year or less, and long-term assets, sometimes called non-current assets, you will see that sometimes, which last longer than a year. Just remember, it's not, I've shown you some types of things that come into each of those categories. Remember that it's not really the specific category, it's the length of how long it lasts. Anything that can become cash in a year or less is a current asset. Anything that lasts longer is a long-term asset. Liabilities represent obligations. They are something you owe to someone else. Like assets, liabilities break down into current and long-term or non-current. So these are just some of the possible categories. Accounts payable you might expect to receive within this year, interest, stuff like that. One thing you need to pay attention to on here is an item called current portion of long-term debt. This is the amount of all of your loans payable that will be due in the next year, and we do separate those out on the balance sheet. Capital cost. This is a source of a lot of confusion. This is used to denote a payment for something big. Generally, it involves things that cost a lot and last a long time. It can be new infrastructure. It can be rehabilitation and replacement of infrastructure. Key point, a capital cost always involves a long-term asset. You buy a new long-lived asset, it could be a vehicle, a plant equipment, or something that's expected to last longer than a year. Paying for a capital cost or for a long-term asset is not an operating expense. They never show up on the income statement. Capital costs also usually involves a long-term liability. It's not necessarily though, because you could buy something outright, like something small, like maybe a truck. But if you do that, it's still a long-term asset. It's just not, doesn't also involve a long-term liability. Good a place as any to talk about depreciation. It can be very confusing. It is simply a way to spread the cost of a large asset over its life. So suppose you buy a truck for $20,000, don't know where you'll find one for that, and maybe you expect it to last 10 years. You do not take a $20,000 expense in the year you buy the truck. Instead, you spread it out over the 10 years of its life. This makes sense because if you took it all as an expense in the year that you bought it, it would make your expenses seem a lot higher than they are, even though you paid for it. So a depreciation is a way to make it more realistic by costing it out over the life of the vehicle. So we could also, no, I don't want to talk about that. Never mind. So we're going to go through a couple of examples. Revenue coming in, money coming in. So over here, money comes in from customers. This increases the cash. It increases your operating revenue. When money comes in from a loan, it also increases cash, but it does not go to operating revenue. It increases a loan payable. See what else I have to see it. Now, if you're using a computerized system, you may not ever really have to worry about this because things are set up to go where they need to go. But you do need to understand either way that money that comes in from a loan is not operating revenue, even though it's money. Second example, money going out for a capital cost. This is where a lot of systems get into trouble, I think. In an ordinary day-to-day world, money goes out to pay all kinds of stuff, salaries, electric bills, whatever. Decreases your cash, increases your operating expenses, which incidentally decreases your net income. But when money goes out to pay for something like a plant upgrade, also decreases your cash, but it does not increase your operating expenses. It does not go there. It increases a long-term asset. Now, hopefully you'll see this a little bit later. We have the two financial statements, and they interrelate with one another. And this is one of the ways. These things over here are all happening on the income statement. These things are all happening on the balance sheet. So when the term debt service simply signifies the payment, the annual loan debt, the loan payment you make. My tongue's getting tied. It is made up of two components. You have principal, which decreases your loan, your debt, interest, which is an operating expense. So these decrease cash. Of course, money going out always decreases cash. Here you have the two parts of the financial statements working together. One money goes out. This is a balance sheet. This is a balance sheet. This is the income statement. They are interrelated. So this little diagram I borrowed from someone else. I think it's really nice. It shows kind of all the flow of your money in your day-to-day operations. Operating revenue comes in, you pay for operating costs. You can pay for capital projects or partially. You can pay for debt service. You can put some of that money into reserve funds. Reserve funds can be used, generally are used to pay for current capital projects. They can be used to pay for debt service. Money from loans, bonds, grants, that kind of thing. See, it's even a different color. Can only be used to pay for capital projects. Just to make that really clear, proceeds from loans, bonds, and grants can never be used to pay for operating costs. Reserve funds, I just want to say a little bit about reserve funds, which we haven't talked about before. You can kind of think of them like savings accounts. We do see reserve funds that are for emergency use, and they might pay operating expenses when you're in an emergency. Most of the time, though, reserve funds are used as capital reserves to pay for future capital projects. And another one we see is debt repayment reserves. Some lending agencies, probably most lending agencies, require that you keep a debt reserve fund so that they can be assured that you can pay your debts. So reserve funds are also, and I think Luke will go over this, one of the things that you need to consider in formulating your rates. Because if you need a reserve fund, you have to build something into your rates so you will have the money to do it. Last topic, financial statements. I don't know how I'm doing for time, but two main financial statements. Income statement, also known as the profit and loss or P&L, shows your revenues and expenses. Balance sheet shows your assets and liabilities. And as we saw a little bit before, without going into this in great detail, they interrelate. Some of your transactions you do involve both of these statements. Some involve only one. An income statement, definition of an income statement is it is a summary of operating activity over a period of time. It could be a month, a quarter, a year, whatever. It shows revenues and expenses for that period. It tells you how much money you took in each category of revenue, how much you spent for each category of expense. Shows whether you had a profit or a loss. Some people might think you shouldn't have a profit because you're a water system. But when you have what shows up as a profit, it's not really a profit like a private business might have, where you would then distribute that to the owners. It's really your operating capital. So this is an example, very simple example of an income statement. You can see that the Somewhere New Mexico water utility did have a profit. Income statements can look simple like this. They can go on for pages and pages, but this is the gist of what's on it. Revenue, expenses for a period of time. On the other hand, a balance sheet is a statement of your financial position at a moment in time. So it shows the value of your assets and liabilities as of the date of the balance sheet, and it can tell you a lot about how healthy your business is. It looks pretty much like that. Assets, current assets, long-term assets, current liabilities, long-term liabilities. You usually get them at the end of the year. You could get them anytime. What else do I want to say about that? You want to notice the as of date. That's like, it's just as of that date. It doesn't tell you anything about what happened during that period. That's what the income statement is for. On here, you notice that the Somewhere New Mexico water utility has more assets than liabilities, which is a good thing. This is something that Heather's going to talk about. It speaks to your credit worthiness and whether or not you can get a loan. So I'm pretty much at the end. I hope I didn't run over my time. I don't know how I'm doing. Anyway.
Just a few minutes over, Sandy. We're doing really good on time. And I did put the other link in the chat, the other one that you had there for the EPA resources. I put that one in the chat as well. And we're doing good on time. So I think we're ready to move into Luke, who's going to.
Before I go,
I
want to thank you for listening this morning, all of you. I don't know, but I sincerely hope that you learned something you wanted to know. And then I will stop sharing and Luke will be up next.
Yeah, Luke is going to talk about rate setting and rate structures and understanding rate structures and that sort of thing. So we'll kind of take what Sandy had and we're going to build on that and say, okay, well, now we're going into the rates and that whole issue of the rates. So that's next. And then we'll talk about financial indicators after Luke.
All right. Are you able to see my slides okay?
Yep, they look great.
Perfect. Okay. So as she said, my name is Luke Andrews, and I'll be presenting a section on rate structure design, revenues, and system goals. In this section, we're going to cover the relationship between these three things, as well as the elements of rate structure design and how rate design can help you meet your utilities goals. So there's several questions that you should consider when you're reviewing your rates. The first and foremost consideration is, will your rates be sufficient to cover your costs? Extending from this, you will also want to think about what exactly this means and what needs to be done to meet those costs. Are you following state law in your rate structure design? Where does the burden of water cost fall in your community? And are you allocating costs to the right customers? Will the rates and rate structure be understandable to your customers? Will your customers be able to pay the rates? And do these rates send the right signals to our customers based on our objectives? We will dive into each of these questions a little more as we move through this section. Because it is ideal for your rates and fees to account for all or most of your system's revenues, your rates should effectively be the answer to the question, how much money do you need? The rates should always be enough to cover your expenses and, if necessary, to build a reserve fund as well. This is called full cost pricing. To understand how much money we need, we must understand our expenses. Here's a list of some expenses and financial needs that should be considered when you're setting your rates. Operations and maintenance expenditures, taxes and accounting costs, contingencies for emergencies. This should include planning for budget shortfalls and lower than expected revenues, as well as planning for emergency costs such as repairs. Principal and interest on long-term debt, reserves for capital improvement, and source water protection. You should start by examining your current budgets and consider how they've changed over time. If your rates and/or budget has not changed much or been examined in the past 5 years, it is a good idea to re-examine them now. Wherever possible, you will want to include any future expenses that you know of, including continued debt payments and future capital improvement projects. Don't forget to account for inflation and rising costs, as well as potential changes in your customer base. A few things to take note of while moving through this process. Do you have good detail on your operations and maintenance costs? All of these costs should be accurately recorded so that you have a strong idea of what these regular expenses are costing you. Detailed and accurate records of O&M costs through the years can help you get a better idea of how these costs have changed over time, which enables you to better plan for the future. Is your capital planning complete, and is it realistic? Capital improvement is not something you want to do on the fly, so it is important to plan out what your needs will be and how you will meet them. And of course, these plans need to be realistic in light of your current budget, the project costs, and the ability to secure necessary funding. You also want to keep in mind your utility's goals so that rate structure can be designed to meet those goals. Understanding what the utilities and community's goals are is a very important component of rate setting. When you have a clear idea of what exactly you want to get out of your rates, it becomes much easier to design a structure that helps you get there. Here are 4 example goals that a water utility might have. Utilities have different objectives, some of which may be supported or discouraged through the rate design structure. While some of these objectives are complementary, others may be contradictory. For example, a utility wishing to encourage conservation and foster business-friendly practices might be conflicted over the use of a single increasing block rate structure for all of its customers. The increasing block rate structure would be helpful for encouraging conservation, but might not be the best way to foster business-friendly practices, as the higher cost at greater consumption levels could be discouraging for businesses. Another example of contradictory goals is affordability and full cost recovery. A utility wishing to maintain affordability by keeping base charges and rates low for low-use customers might have to sacrifice its need for month-to-month revenue stability that can be maintained through higher base charges. It isn't a bad thing to have contradictory goals, but because some of these objectives require trade-offs when designing the rate structure, It is a useful practice for the utility manager to begin by ranking the objectives first and always referring to the top ranked objectives when trade-off decisions appear. Next, let's look at the elements of rate design and how they can be used to help your system meet its goals. These rate setting guidelines provide information about the following elements of rate structure designs. The guidelines should be followed sequentially, so we will start by looking at number 1, customer classes and distinctions. Utilities have several options in deciding how to charge different sets of customers. However, utilities can only legally charge different rates for customers based on cost-related factors such as usage. Hence, it is possible to set a rate structure for residential customers and a separate rate structure for commercial or industrial customers, since the non-residential customers use a lot more water and the marginal cost of providing them with additional units of water is very low. Utilities cannot charge lower or higher rates to customers based on non-cost related factors. Therefore, providing discounted rates to senior citizens or low-income customers purely on that basis is illegal. One advantage to creating different rate classes of customers, as shown here, is that it provides the utility with greater flexibility in targeting different objectives for different types of customers. For example, a utility could charge increasing block rate structures for residential customers to encourage conservation, but also charge uniform rates for non-residential customers to avoid overburdening them with excessively high rates. Residential irrigation meters provide the utility with an ability to charge residential customers a different rate structure for their outdoor water use, which is mostly seasonal and discretionary. Before
Luke,
adding,
just 1 minute, please. We have one person who's not muted, I think. If you could check your mute again, and it's the microphone symbol, and you need to have a red line through the microphone to indicate that you're actually muted, because we do have one person who does not appear to be muted right now. So, or if you're on your phone, you just need to use the mute button on your phone. But if everybody could just check that and make sure that they have the mute, the line through the microphone so that we can not have the background noise, that'd be great. Thank you.
all right. So before you add new rate structure classes, utility managers should first assess the ability of their billing software to handle the complexity of this switch, and also your staff's ability to make the conversion, which will require you to more continuously monitor and assess the inevitable increase in billing errors. So next, we'll look at the billing period. The advantages of using monthly or longer than monthly billing periods are shown here. From a customer perspective, monthly billing is the structure that provides the greatest advantages than any other billing period. A utility must evaluate the trade-off between increased operating costs for meter reading and billing against the advantages of monthly billing, including providing a much more stable month-to-month revenue stream. Additionally, our research finds that customers who are billed quarterly or bi-monthly use more water on average than customers who are billed monthly. Hence, a conservation-oriented rate structure would use monthly billing when possible. We suggest that you use a monthly billing period if you can afford the additional meter reading and billing costs. A base charge is the amount a customer is required to pay each billing period, regardless of the amount of water that is used. This is oftentimes called a minimum charge. Base charges are highly stable sources of revenue for utilities since they are immune to water use behavior. There is an incentive to charge as much of the fixed costs of running the utility in the base charge as possible, tempered only by affordability since all customers pay this charge. The higher the base charge, the more stable the utilities revenues will be, but the less sensitive the total customer bill will be to changes in usage patterns. Hence, a customer reducing use significantly will not see a proportional decline in their bill if the base charge is a large component of the total bill. Utilities concerned about setting conservation-oriented rates by utilizing usage-sensitive rate structures are more likely to charge lower base charges and higher volumetric rates. Also, utilities concerned about affordability may find it difficult to set a high base charge, as it reduces the ability for the customer to moderate the size of their bill. Due to the capital-intensive nature of water utility costs, and because of economies of scale, large utilities are able to spread their costs over large customer bases, and thus are often to charge lower base charges. Smaller utilities typically rely on higher base charges to recover some of their fixed costs. In order to offset some of the burden of high base charges on their customers, utilities sometimes include a minimum consumption allowance with the base charge, such that any use within the consumption allowance is already paid for by the base charge. As with base charges, the higher the amount included in the consumption allowance, the less sensitive the total bill will be to water use reductions, and the less conservation-oriented the rate structure will be. Unlike with base charges, however, the utility has no revenue stability incentive to include higher amounts of water in the consumption allowance. In fact, the more water is included in the consumption allowance, the less revenue the utility can expect to collect from the majority of its customers if the base charge is not adjusted accordingly. Next, let's look at different rate structure types. Utilities in New Mexico use a variety of rate structure types. The most common are uniform rates, often called flat rates, increasing block rates, and decreasing block rates. In the past few years, utilities have been switching away from using decreasing block rate structures for residential customers and adopting either uniform or increasing block rates. We'll get into why in just a minute here. There are a few unique rate structure types as well. Beyond those that we'll cover here, we are going to focus on some of the more basic rate structure types and not the more complex ones that are available. The utility manager should select the type of rate structure that best fits the primary rate setting objectives that you identified previously. Uniform or flat rate structures are the simplest type of rate structure because the price per 1,000 gallons of water does not change no matter how much you use. Uniform rate structures carry the advantage of being very easy to understand and are often considered the most fair rate structure, as everyone is paying the same rates based on their usage. Because there is no change in the cost of water as consumption increases, this structure does not effectively encourage conservation. There is also no cost reduction for the larger commercial or industrial customers, so this may not be the best choice for a utility seeking to foster business-friendly practices. In a decreasing block rate structure, the price per 1,000 gallons of water decreases as consumption increases through the defined blocks. For example, a utility might charge a higher price per 1,000 gallons for the first 10,000 gallons, and then charge a lower price per 1,000 gallons for all consumption after that point. This type of structure can be beneficial for keeping water bills lower for commercial and industrial customers that have high consumption levels. Water utilities should avoid using this type of decreasing block rate structure for residential consumption, as this can discourage conservation and reduce overall revenues collected. Some utilities have a single decreasing block rate structure for all customers, but set the first block size to be large enough to cover a significant amount of water, for example, 50,000 gallons a month, in order to essentially charge residential use at a uniform rate while providing decreasing block rates to commercial and industrial customers, as the residential customers are not expected to exceed the 50,000 gallons contained in the first block. Again, this type of rate structure is not a good choice for residential customers unless you plan to make the first block large enough to effectively charge all residential customers uniform rates. Increasing block rates work the opposite of decreasing block rates. As consumption increases past a defined threshold, the price per 1,000 gallons of water increases. This is a good choice of rate structure for utilities that want to encourage conservation. However, the utility should consider the number of large families living in a single home in the community, as their consumption levels can be quite high, and you do not want to charge them excessively large bills for normal water usage. This type of structure does not work well for commercial or industrial customers when the utility is trying to meet the goal of business-friendly practices, as their generally higher consumption levels will quickly place them in the higher blocks and result in significant water bills. Now let's take a look at block designs for those of you that will use them in your rate structures. Increasing block rate structures alone are typically not sufficient to encourage conservation. The design of block rate structures is critical to set the appropriate price signals to the customers to not unduly overburden certain segments of the service population and to provide sufficient revenue stability for the utility. If a utility will use a block rate structure, they should consider these questions and use data-driven analyses to make decisions when possible. For a utility to target residential consumption with increasing block rates, it should use at least 2 blocks within the normal range of residential use, from 0 through 15,000 gallons a month. It does not do any good to start the second block at a usage level that only a very small number of customers use. In determining the number and size of blocks, it is very useful to analyze from billing records the number of bills sent out each month for different usage levels. Increasing block rate structures for residential use should at least start the second block just over the average residential usage level. If the utility only uses one rate structure for all of its customers, the block sizes at much higher levels of use should be carefully considered from the commercial and industrial customer's perspective. If the difference between block rates is insubstantial, the customer will likely not notice any changes to their monthly bills as they move in and out of later blocks of usage. For a block rate structure to be effective in communicating the higher or lower price of water at different consumption levels, the difference in the block rates needs to be significant. Remember that use of consumption allowance and/or high base charges reduces the sensitivity of the total bill amount to changes in use, and thereby dilutes the effect of the rate structure. Block rates differentials should be even greater in the presence of high base charges or consumption allowances. Similarly, customers who pay combined water and wastewater bills may be less sensitive to the water block rate structure if wastewater is charged using a different rate structure. Increasing block rate structures can sometimes have an adverse effect on larger families that live in a single home. They consistently use high amounts of water throughout the year and may not have capacity to conserve. An increasing block rate structure therefore negatively affects those customers without achieving any conservation objectives. Investigate your billing records to estimate the number of residential accounts that consistently use high amounts of water, and use this knowledge to select the appropriate block sizes to mitigate the effect. Consider using uniform rates or if the community has many large families. Although the frequency of rate changes is not an element of the rate structure design itself, it is an important policy objective that should be addressed by the utility. Ideally, utilities would review their rates and rate structures annually to adjust them to changes to the utility or customer characteristics. At the very least, utilities should review their financial performance indicators annually and review their rates and rate structures when any of the indicators reflect poor financing. Heather is going to walk us through those financial performance indicators a little later. A few utilities choose to pass an ordinance or internal policy to adjust rates annually based on inflation. While this step is certainly better than not reviewing and adjusting rates at all, it should not entirely replace the process of reviewing rate structures and rates. Occasionally, reviews will still be necessary to ensure that the rate structure and rates are aligned with current conditions. It is very important that utilities avoid maintaining artificially low rates at the expense of the utility's financial health. This leads to deferred maintenance and capital improvements, and either to a sudden massive rate increase in the future or a failing system that can result in risks to public health. So we have this free guide for rate structure design. This was developed by the Environmental Finance Center at the University of North Carolina. And this provides a more in-depth look at all of the things that we've just covered in this section. And it can help you more effectively design a rate structure that can meet your system's goals, cover your costs, and communicate the why of your rates to your customers. So be sure to check that out if you would like further guidance on setting your utilities rates. I am going to get the link to this document posted in the chat in just a moment. And next, Heather is going to discuss the financial health indicators that can be calculated using our water utility financial analysis tool.
Okay, great.
All right.
So let me make sure that Luke, Sandy, is that all? Francine, is somebody just give me a wave saying that it's all okay if you're seeing the right screen?
Yes, it's good.
Oh, great, thank you. So coming down the home stretch, we're going to talk about financial indicators. So why might you want to do anything related to financial indicators? And the biggest reason is you're going to have a bunch of numbers. So Sandy talked about all the different kinds of numbers you can have. You can have P&L statements, you can have the revenues, expenses, all these different things, and you have lots of numbers. And just looking at a whole bunch of numbers is not going to really tell you how healthy your system is. And am I doing well? Are you doing what you should be doing? Is the system looking good? So we can use financial indicators to kind of help us with that. So what indicators might we use? There's 5 that we're going to talk about today. There are some others. So it's not like this is a completely exhaustive list of every indicator that is out there. So we're choosing 5 that are in that water utility financial analysis tool that I showed you earlier. And what you're going to see today is information in a large part from that tool. So you can see the kind of things you'd get if you put any information in there. So we're going to talk about the current ratio, operating ratio, debt service coverage ratio, debt ratio, and sales ratio. So the current ratio is pretty simple to understand. It's current assets over current liabilities. And as Sandy talked about, she made the distinction between what current assets were versus the long-term assets. And the same thing with current liabilities. So this is really just a measure of your liquidity and your ability to pay your short-term debt. So we're talking about a shorter time horizon with the current assets and current liabilities. And when you do the calculation, if it's greater than 2, your utility is basically in really good health. You have twice the current assets you need to cover your liabilities. If you're between 0.5 and 2.0, there's a little cause for concern because you might not be able to cover your short-term debts. It might be okay, but you're kind of on that bubble where you might want to consider changes that you need to be making. And then if you're less than 0.5, your utility cannot cover its debts. So you're in poor health for this particular metric. So an example, this is a dial that is in our water utility financial analysis tool. And this particular, the example data that I talked about that you could get shows a system that has a ratio of 5.39. It's more than 2, so the dial will show that it's green. It's in the green zone. The operating ratio is the total operating revenue divided by the total operating expenses. So it's a measure of the ability to meet current expenses, and it's a measure of self-sufficiency. So how well are you doing? Are you depending on just the revenue that you're bringing in to pay your expenses? So it's really about being able to meet these needs from your own customers. And the ratio levels are greater than 1.6. The utilities revenues exceed expenses by at least 40%. And you want your revenues to exceed expenses. You don't want it to be just, exactly matched. And one of the reasons is the pandemic we're having right now. People had times where they couldn't pay their bills because a lot of people lost their jobs and, bad things happened. So if you were right at that point where the revenues and expenses were exactly even, you might have a lot of difficulty. You don't have any sort of margin for error. So having a ratio greater than 1 is very helpful. And then between 0.5 and 1.6 is a concern, and less than 0.5, your utility expenses exceed your revenues. So that means you're operating a loss. That is not where you want to be. That's not a financially healthy place to be. So again, looking at our dial, this particular dial from our sample data has a 0.95 ratio. So they're in the yellow zone or the caution zone. The debt service coverage ratio is calculated by taking your net operating income, not including depreciation, and dividing it by your annual debt service. And that includes both principal and interest. And your net operating income is your operating revenues minus your operating expenses. And again, it excludes depreciation. So it's essentially this quote leftover cash, if you will. You paid all your bills, how much money is left over? So it's kind of giving you ideas of whether you can pay your debt. After you've covered your daily expenses, do you have enough money to cover your debts? So greater than 1, you have enough money to pay all of your expenses as well as your loan payments and interest, and you have a little bit of a cushion. If you're between 0.5 and 1, your utility is just meeting your expenses and paying your debts. You don't have any cushion. So you could be in trouble. And if you're 0.5, the utility can't meet all of expenses and pay its debts. So that would be a poor financial health condition. And then here in our example, the ratio is 2.3, so utility is doing okay. And then the debt ratio is the total liabilities over the total assets. And again, Sandy talked about this, the difference between the current and total liabilities, because we had that ratio before that was current liabilities and current assets. This one is total liabilities and total assets. So it's a proportion of the assets that are financed by debt. So less than 0.3, and in this case, lower is better. The assets are higher than the liability. So we want our assets to be more than our liability, again, so that we're able to pay those debts that we have. If we're between 0.3 and 0.7, that's a cause for concern because assets are coming closer to liabilities. And then the liabilities may not be covered if the ratio is 0.7. And if it's 1 or greater, even selling all of your assets wouldn't cover your liability. So that's a very unhealthy place to be. So the debt ratio in this case, the example is 0.16. And then the sales ratio is user charges or fees divided by total assets. So this is a measure of the percentage of your total revenue that's coming from your user charges. So it's trying to tell you how much of those expenses are being met by revenue from your customer as opposed to other sources of financing. So if it's more than 0.75, your utility is covering your expenses with user fees. So meaning that your customers are paying your, most of your expenses, and you are fairly healthy because the money is coming from the people who are getting the service. In between 0.5 and 0.7, there's a cause for concern, and less than 0.5, only half or less of your expenses are paid by user fees. So that means you have to rely on outside sources. And outside sources may be less stable because, the government that you're in, like your city government or your state government or tribal government, whatever kind of utility you are, may not continue to give you that revenue. They may decide that there's no money in the budget, and now you're in trouble because you don't have that outside source of funding to cover your expenses. And so the debt ratio in this case is 0.16, so it's in the green zone. So if we take all indicators as a whole, so that's all the indicators I've shown, we want to say, what do they tell us taken as a whole? Because we don't want to consider just one indicator by itself. So in this case, the utility is generally financially healthy, but it does need to watch its operating ratio, which shows that the revenues are not fully covering expenses. So they want to be a little careful here on that one ratio, but the rest of the system looks pretty good. So this would be a fairly financially healthy system. So now let's look at some other indicators. In this case, we have 3 in the yellow zone, 1 in the green zone, and then, I'm sorry, 2 in the green zone. I can't count today. 3 in the yellow, 2 in the green. So in this case, the indicators are telling us something slightly different. It's a little more precarious financial health. It's kind of on that borderline of whether the utility is healthy or not. So the utility would probably want to take some action to get more into the green zone with the 3 dials that are in the yellow zone. So they'd want to do something to make themselves a little bit more financially healthy. They're maybe in terrible shape right now. They still have room to do some things. It's not like it's disastrous right today, but they would want to take a look and see if they could improve their situation. What about in this case? In this case, we have, let's see, 3 of them in the red and 2 of them in the yellow. So if we had this set of indicators, what might that tell us? That would tell us the utility is probably in very poor financial health. We have all of our indicators either in the poor zone or the fair zone. The utility should consider taking action immediately to address its situation because it's probably not covering its day-to-day expenses. At some point, it's probably not going to be able to continue to provide water to its customers, and things could get really bad. So this is a utility that would want to take some action right away to try to address the situation. We want to remember that no one indicator says it all. The reason we talked about 5 of them is because no one indicator by itself is going to paint that overall picture of financial health. We really need the whole picture to be painted. So if we consider this system and just said, okay, here's the indicator. We have an indicator that shows it's in the red zone. It's the sales ratio. It shows things are really bad. If we just look at this one indicator, we might think the system is very financially unhealthy. But here's the actual situation for this utility. I only cut out the sales ratio. If we look at the other ratios, we have 3 in the green and 1 in the yellow. But the only one that's in the red is the sales ratio. So that would tell you a slightly different story. That might say the utility is, they're doing okay. They could make some changes, but they're not doing horrible. They just need to maybe look at a couple of their indicators to see if they can make things a little bit better. But if we only looked at this indicator, it's the same system again. In this case, it's in the green. We would say, oh, everything is great. But if we looked again at the whole picture, we would notice that there is 1 in the red and there is 1 in the yellow. So you always want to look at more than one indicator because they're telling you different things about your water utility. And for overall health, we want to have a whole picture. So again, if we look at one indicator would tell us is good, another indicator tells us is bad, but the overall picture is probably, say, fair to okay. Maybe need a little bit of work. So again, we want to look at the whole picture of the indicators and not just pick one indicator by itself. So just to remind you again, this all came from the Water Utility Financial Analysis tool. If you enter your data into the tool, you will have these indicators automatically populated for you. If there isn't enough data to calculate it, if you haven't entered information, the dial will just be grayed out and it actually gives you a notification that says you haven't entered data. And once you do enter the data, the dial will be calculated. And you can use this to create scenarios and try different things. And I believe we're going to have Luke and Sandy kind of walk through how you can do that using the sample data. So the sample data in the tool is what allowed me to show you these indicators today. So we already have some data populated in the tool. So if anybody wants to see how it works or you want to play around with it yourself, you're welcome to. And there is a button for clearing entries. So when you're all done playing with it, you can clear the entries and you know, get started with your own data. The sample data will always be there for you. But if you put your own data in there and then choose the sample data will overwrite your data. So you don't want to do that if you're trying to use your own data. You just want to keep sticking with your own data. Or go to a different computer and get the sample data there so that it doesn't get overwritten and that sort of thing. So with that, I'm going to open it up to Sandy and Luke to maybe walk us through a little example of how the tool can be used.
Okay.
I just put the link to the tool in the chat for anybody who wants to work along with us as we move through this, or to just look at the tool. It's right in the chat there.
And we did have a question about, did they need to save the chat to be able to get the links? So that is one way you can save the chat. Another way is we have had a request to have these PowerPoint slides made available to you. And so we'll create a handout with the slides and get it out to everybody. And we'll put the links in a handout for you so that you can have them all right there. So if you just open that handout, you can just click on the links that way.
Okay, do you want me to start?
Go for it.
I'm going to share my screen if I can find the WUFA tool. No, I can't. Shoot. I had it up here. Let's see. There we go. Now, hopefully you guys should be seeing my WUFA tool. I'm going to give you just a little quick tour of the tool. When you open it up, you'll see this start page. Nothing happens until you click somewhere else. So normally you would start here with revenues. You can start anywhere, go back and forth. But as Heather said, if you start on financial health and you haven't put stuff in there, you won't see anything. I've got sample data in here. It's a little different from the standard sample data, but it's very similar. So you can see if you're over here, this is the cool part, and you hit here, you can see those gauges light up. And going back, just to reiterate, if you go through revenues, you've got all the categories we talked about: operating revenues, non-operating revenues. Where would you get this data? Ta-da, your income statement. It's all right there. Same thing with expenses. It's all on there. Now, you cannot change these categories. So if your categories don't match exactly, you've got to make yourself notes, or, you know, sort of, they're pretty universal categories. Assets and liabilities come right off your balance sheets. They're categorized just like we talked about. So if I wanted to look at this, if I looked at the financial health of this and I wanted to say, well, you know, as Heather said, we're really in pretty good shape. But this one right here, the operating ratio, which has to do with the relationship between your operating revenue and your operating expenses, is a pretty important one. So it's not looking too good. I would like it to look a little better than that. What could I do to make that better? Well, once again, we have the definition right up here. You will see everywhere you see these little eyes, there's a definition that tells you what that is. Even back here, operating revenue tells you what that is. So operating ratio is the proportion of operating revenue to operating expenses. So that's pretty important. If you're not doing too well there, you're not generating enough money to pay all of your expenses. In this case, you are, but we'd like it to be a little better than that. So just to, if you want to play around with this, what could I do that would make this better? Well, I could increase this number, or I could decrease this number. And we all know that decreasing expenses is pretty darn hard. Increasing revenues can also be kind of hard, but you do have a way to do it, and that's with your rates. So we're just going to play a little bit, and I'm going to try a couple of scenarios. Like, suppose I had 10% more revenue. Now, I want to caution you, this is not a rate setting tool, but it can give you some broad guidelines of where you might need to go. So if I increase that number for my user charges by 10%, and I'm cheating because I already have some numbers ready to go because I don't do math that well. And then I go over here, we can see that got a little better. So even 10% made it a little better. Not quite better enough, but suppose I try 20%. Getting much closer. So I'm not going to do a whole bunch of examples because I think you can see how you would play around with this. You can play around with it just using the sample data, but really the power of this tool is for you to put your own data in there and then play around and see what you would need to do to make your utility a little more financially healthy. It's harder to deal with assets and liabilities, but you could look at the consequence. If I were to take on another loan, what would that do to this? So it's meant for you to be able to get to these gauges, these ratios by yourself without having to extract a bunch of numbers from a lot of different places. So we're hoping it'll be helpful. We're getting short on time, so I'm gonna let Luke do another one because Luke loves to play. And I can only figure out how to, oh, here we go.
All right, thank you, Sandy. So yeah, let me share my screen here, and I've got another scenario for us, just like Sandy was doing there. So I already went in here and populated this with a set of sample data. And as you can see, we're doing really good on all of these ratios, except the sales ratio, we're in the caution zone. So not terrible, but something to look at. So we would start by saying, what is the sales ratio? Get the definition like Sandy showed us. It's the user charges or fees over your total revenue, a measure of the percentage of total revenues that come from user charges. So you're just looking at how much of your revenue is coming from your rates and fees and how much is coming from somewhere else. And ideally, the majority of your revenue would be coming from your rates and fees. So the lower this ratio is, the worse off you are. And as we can see, we're looking at our revenue here. So that is where things would have to change in order to affect the outcome that we have here. So we've got our revenues, and we know that what we're essentially looking at is we want the proportion of operating revenues to be higher than it is, and we want the proportion of non-operating revenues to be lower than it is. So the two basic things you could do is you could reduce non-operating revenues or you could increase operating revenues. And it likely comes as no surprise, we have 200,500, that if we reduce our non-operating revenues, let's see what happens. So this did help out the sales ratio, but while we haven't dipped into the red zone, some of these other ratios are actually starting to go down. because our total revenues have actually decreased. And as it's no surprise to you, that's not something you actually want to do. So put that back, 200,500. We're back where we started. So that tells us that what we want to do is increase our operating revenues. So let's say a 20% would put us at 600,000. If we raised our rates 20%, let's see what happens. We were at 0.7. That gets us to 0.73. So about half, most of the way that we needed to go. So we need to raise our rates even more. Let's look at what would be a 40% increase in rates from 500,000 to 700,000. And that gets us into the green zone. So you can see how this tool allows you to play around with things and see what different changes you would need to make in order to affect the outcome that you wanted to see. In this case, that's a really significant rate increase. But sometimes that's what you have to do. Maybe this system has not analyzed their rate structure or their budget in a long time, and this results in them having a big leap. That's the exact type of thing that you want to avoid. And so that's why it's a good idea to regularly do these assessments and regularly look at your financial health indicators. And with that, I think we're really close to time here, and I think we had a bit of an outro, so let's move into that.
I wanted to share one thing real quick is just, we've been talking about how to use the sample data, but it may not be clear to everybody how to get your own data in there. And I just want to make sure you know how to do that. So this is the tool when it first comes up. And when you continue, you're seeing the sample data. What I can do is hit clear entries. And it'll say by selecting OK, all of your entries will be deleted. I want that to happen because I want to put my own data in there. So I will hit OK. Now I have to go back to the continue button and you'll see zeros everywhere. And then if we go to, excuse me, if we go to the financial health, this is what I was talking about before, where there is no value on the dials at the moment because we don't have any data in there. So we would have to enter data for it to actually populate these dials. So, you know, you would go in, oh, go ahead.
I'm not sure when it comes up, we're bringing it up because we already have this in there. I'm not sure when you first bring it up, whether it brings up the sample data or brings up nothing, but it doesn't matter because you can move in and out of there easily if you want.
Yeah, and you just click, if you want to put the sample data in there, you just click on the sample data, you get that. If you want to clear entries, you just clear entries. Whoops. And then we want to hit continue.
And I also want to make it clear that when you close, this will save whatever is in there in cookies in your browser. So if you get partly done and you want to come back or you still want to play with it, as long as you don't clear your cookies, you will still have your information as long as you come back in the same browser on the same computer. But we're not saving it anywhere on any of our servers. It's in your browser. So that's all. I'll shut up.
Yeah, and we're going to look at possibly adding a print feature where you could actually print this. But the reason that it's through the cookies is we don't want your data. We don't want to have your data. That's your data. We want you to use it and do what you want. We don't want to collect your data. So you can rest assured whatever you do is just for you. It is not coming to us. If you want assistance using it, you're welcome to contact us and ask for assistance. But it isn't like you're putting this data in and we're collecting it, because we are definitely not doing that. So if you want to try the sample data, I would suggest do that first. Play with the sample data and see how it works, look at the dials, you know, kind of look around in the tool. And then when you're ready to do your own data, just hit the clear entry button and everything will be back to 0. You can always play with the sample data as well. If you change any of the sample data, all you have to do is click the sample data button again, and it'll bring up that original sample data. So you can feel free to play, you know, any way you want. I think we just have one poll question, if you could bring it up, Francine, about the, if you would like assistance. So we wanted to see if anybody wants assistance. So there is a poll question that we're going to put up. And if anybody wants assistance and you already know that you want that, let's see. So that would be poll 8. So you have to bring up just poll 8.
1 second, I'm having a hard time just activating it.
So just, it's technology. We have one of our folks who normally does the polls is out with some family emergencies. So we're learning some new technologies today. But there are other ways to get assistance. You can directly contact us. You can use the EFC network website and go to request assistance and you can fill out the form. But if we can get this poll to work, we will also have a poll question for you.
Okay, just give me 1 second and I'll try it again.
Okay. Okay, so the poll should be open. You should be able to click either yes or no. If you would like assistance from us, we're happy to contact you and talk about what you need from us. You know, whatever it might be. If you just want to talk about your rates or you want to find out how the tool works or anything like that, you know, feel free to let us know. And with that, I want to thank everybody for being on today. We appreciate your time and your attention. We wish you the best in trying to use the local government division. I forget the acronym,
LG, no.
LBGL, local
LGBMS.
Managed data management system or something like that. LGDBMS or something like that. It's a very hard acronym to remember. I know what it is, but I can never remember the acronym for it. But you know, if you have over that 50,000 revenue and you have to use the system, we wish you the best of luck. And somebody did point out maybe you don't need assistance now, but you might in the future. Again, just keep us in mind that we're here to help you. And it is free to you. Hopefully that was clear enough. But if not, wanted to let you know that the assistance under this contract is free. It's being paid for by EPA. So if you need any help, reach out. And again, thank you all for attending today. We really appreciate your time and attention and wish you all the best.